Hi guys, welcome back to Suero TV. I'm Lord Takpata, your usual host. So today we have James Fern in studio. Today we're going to be talking about his life journey. James runs SCI. If you actually know about it, it's a personal finance wealth management firm. So we're going to talk about his journey on it, how he formed it, and he's also quite passionate about personal finance as well, managing money. So we're also going to touch on that, and I hope you get inspired by his journey. James, welcome to the show.
Thank you very much. Welcome to my little boardroom.
Thank you for allowing us into your space, and thank you so much for creating time for today. We really appreciate it. I mean, we know how busy it gets, and you doing this means a lot for us and our viewers. James, how are you doing?
I'm great. I'm really good. I'm hectically busy.
Yeah.
I don't know whether it's this year is an election year.
Yeah, it is.
Yeah.
Yes.
Like everybody seems to be a bit more positive. Certainly my business owner clients are finding that money is moving in the economy a bit faster. They're getting paid a bit easier. They're more positive about business.
Yeah.
And that in turn generates work for us.
Is that right? That's quite interesting, actually, that the election year changes that as well in many moves.
I'm guessing here.
It could be.
Yeah.
You haven't observed in the past years that?
No, so since COVID, Botswana really hasn't bounced back the way it should have done.
Yeah, so now it's starting to bounce this year, surprisingly.
Up in Maun, the tourism business,
I
think has bounced back.
Yeah.
Yeah, because they took such a hit from COVID.
Of course,
nobody internationally came to Botswana full stop for almost 2 years.
Yeah.
And then last year, they really rebounded. There was a lot of pent-up demand internationally for what Botswana's got.
Yeah.
So they're coming up to the start of their season now. Their season really starts in April time, but they're feeling more positive.
Yeah.
And I think in business like that, your attitude's everything.
Yeah, no, absolutely.
If you sit down and you go, you bemoan your fate.
Yeah. And also it trickles down to the rest of the team, everybody.
Sure.
Yeah. So if you are more optimistic, if you are more enthusiastic, everything else changes in the business and trickles down to everybody else. This is basically what you're communicating.
Yeah. So my dad had a saying, smile and the world smiles with you.
Yeah.
Cry and you cry alone.
Is that right? Do you cry alone, or you attract the crying people too?
Oh no, I think generally stay away from crying people.
No, I mean when you're crying, you attract what you are. Basically.
Well, perhaps so, but I don't. Yeah.
Okay, so James, I want us to get into a bit of who you are and who's James Fern. Where are you from? How long have you been in Botswana? Are you now in Botswana? Let's talk about that.
Okay. How long have I been? I came here in 2000. Yeah. So start of the new millennium. And I arrived in Botswana on February the 14th, Valentine's Day 2000. And I fell in love. Yeah. I fell in love with Botswana.
Yes.
24 years and counting. I'm originally from the UK, South Wales, school in Bristol, university in London. And after university, I was running a small business in London. Straight out of university, I did a startup. And I had a friend who was working out here. And every time he'd come back to the UK, we'd play some golf together. Yeah. And he'd tell me these wonderful stories about how great life was in Africa. And I'd bemoan my lot and tell him how terrible life was in London.
Where was it terrible at the time? Was it terrible at the time?
Well, London's a great place to be a student. Party. Yeah. London's a great place if you're a high earner. But my goodness me, it's expensive. Yeah. And so if you're doing a startup, if you're a new entrepreneur, 22 years old as I came out of university, it's a horrendous place. It is very, very difficult. Huge amounts of competition. Everybody's busy. Everybody's working in London. Yeah. And he kept saying to me, come out.
Come, yeah.
And then it was the start of the millennium, and I said to my girlfriend at the time,
in London.
In London.
Yes.
Yeah. I said, darling, I'm going to give this a try for 3 months. I took on a 3-month contract. Came out here with a pensions firm, and then stayed.
You stayed?
Yeah.
What did you study in university?
I was mechanical engineering.
You're an engineer?
Yeah.
Oh,
yeah,
this is
yeah.
interesting.
Yeah, it's very. So London University, Imperial College London,
Yes.
is pretty much the world's top engineering university.
Yeah.
And I would say 3/4 of the people who studied engineering with me went into the city, went into finance.
Why?
The big investment banks love analyticals. Yeah, they love people who are computer literate. Engineering is really difficult, so they like people who are, who are diligent. Absolutely, yeah.
But you're also very structured. The thing is with engineers is that they're actually also very structured and very, that's the thing that people get to get attracted about you, I figured, yeah. So you came to Botswana and?
Yeah, well, so I worked for that firm for 2 years.
What is the name of the firm? You don't mind sharing?
They don't even exist anymore.
Okay.
We're talking 25 years back.
Yeah, okay.
Yeah. They specialized in expats. Yeah. But they were a sales firm. They wanted you to sell to people.
I see.
Yeah.
Well, their product, I guess.
Yeah, their international pension solutions.
Yes.
Yeah. And though they would say in their sales pitch that they were all about service, they weren't. They were commission-driven salespeople. There was no basic salary. It was just commission sales. So quite a lot like life insurance is sold today.
Yeah.
And what that resulted in was a transactional sales process. And I felt it didn't work well for the client. So I was talking to people about their 25-year plans, but I was getting paid once to sell them that.
Yeah, what you're saying is there was no commitment for you in the firm because of the relationship you had with the firm, basically in terms of them being committed to you. And so, because what I'm trying to understand is, are you saying had you just been permanently employed, being paid well, the relationship would have been different with the client? You'd even sell better.
No, their entire structure was wrong. Yeah. Their entire structure was wrong. You cannot go to a client and say to them, I'm going to look after you for 25 years. Yeah. If you're only going to be paid once, it's not going to happen.
Yeah, got you.
So
it wasn't true in the first place. Yeah, it wasn't.
So that was the fundamental structure that was wrong.
Yes.
And that was why I decided to start on my own. I think I was probably, I started on my own after university. Anyway, I started an IT firm in London, which failed, by the way.
It did.
Well, it didn't fail. I gave up on it to come here.
Yes,
yeah?
but because you were still
post-millennium, so basically it was solving millennium bug issues for people.
I see.
Back at the turn of the century, and I could see the writing on the wall.
Yeah.
So that, I didn't sell that business for $1 million. I let it go.
You just came here.
Let it wind down. Came out here, and then 2002 started on my own. With a business partner, with two business partners. Yeah. With a business partner and his father. Yeah. And
this is SCI?
This was originally Southern Cross International.
Yes, Southern Cross International.
So that's what we called the business.
Why Southern Cross?
My business partner loved astronomy. And so it was like, the Southern Cross, the constellation in the sky.
I see.
Yeah, let's call it this. And so I started here. We opened an office in Mozambique, and my business partner would go down to Mozambique, and I would come here. And after 9 months, my business partner said, "This isn't earning me enough money."
What did you guys start off as? As the same exactly what you're still doing now?
Yeah, correct.
Oh, okay.
Yeah. We were both financial planners.
Yeah.
So the business after 9 months wasn't generating enough for him.
Yes, I mean, it's 9 months.
Well, there you go. Yeah?
It's business, that's how it starts.
So 1,000 days to success. You have to be able to survive 1,000 days. That's 3 years before your business is likely to.
Yeah, to start anything.
I was very good at tightening my belt, living very conservatively. I hate debt. So, you know, he was a flamboyant lifestyle kind of guy. And after 9 months, he drained the company bank account and ran away.
How did he do that with you there? I mean, I thought withdrawing of, there was nothing like you.
I was
approving.
24 years old. What can I say?
You're 24, yeah.
You're young and you're naive, and you pay some school fees.
Yeah, business lessons, yeah.
Yeah, but he left me with the firm and some clients.
Yes.
And then I carried on. Actually, his father then said, "Oh, I'll stay on with the business," and so the father was sort of the silent partner who was sitting overseas looking after the institutional relationships. And then after about another 9 months, the father did virtually the same to me.
He also withdrew the money and left.
Well, it's more complex than that.
That's but he also left.
So he also left, and I started from scratch. 18 months in, thereabouts, having paid a lot of school fees.
Yeah, I get you.
But it was in my business.
Yeah, it was yours now, yeah?
And starting from zero. So...
Did you change the shareholding, everything? Yeah.
I mean, and remember, we had different entities in different countries.
Yes.
Yeah?
I see.
It was a bit more complicated than just, you know, a startup here.
Yeah.
So then... anyway, so the fast forward, then I was going to be big. I wanted to show them that I could do something better than they could do.
I'm going to win. Yeah. So that was your driving force at the time.
Yeah, I mean, revenge is a good thing. Yeah, you know. Yeah, I mean, not like positive revenge.
But I get you.
I wasn't going to go and let the tires down on the car. No. I wanted to show them that it would work. That they had made a mistake in leaving the business. Yeah. So at the height of then the firm, by 2007, 2008, we had the office here. We had Santon in South Africa. We had Mozambique. We had Zambia,
SCI.
Tanzania. So Tanzania is about as far north as we got. And so we had a good degree of success. Now, I'm paraphrasing a lot. There's a lot of work that went into that.
We need to get into that.
But then I met my wife.
Yes.
And I met my wife here.
Yeah. Is she also Brit?
She was born, I think she was born in the UK. She's Botswana now. Been here far longer than me. And she runs a physiotherapy practice. Yes,
you told me about. I know the story, but yes, and we don't have to go into the nitty gritty of it.
Oh, okay? Really?
No. Okay. No.
We'll leave that as a teaser for your viewers. They can go and have some physio from Tanya and say, "Hey, I heard your husband. So what's the story there?" Anyway, and she'll tell them to go away.
Yeah. That's what I was trying to avoid from James, that part of the story. But okay, yes.
At that time, I was here for maybe less than 1 week of the month. I was in Mozambique, I was in Zambia, I was in Zimbabwe. I was traveling all the time.
Building the business.
I was I'd barely spent a weekend at home. Yeah, it was great, but it was a young man's game.
Yeah.
And I met my wife, and we're starting our family, and I made the decision, okay, I can't do this lifestyle. Yeah.
Especially if you're starting up a family.
Right.
Yeah. How old were you at this time?
So I was born in 75. So I am now 48. So you do the math.
Okay,
yeah?
all right.
All right. I was in my 30s.
Yeah.
Yeah. Late 20s, early 30s. And so we made the decision, okay, where do we want to be? Where's a good place to raise a family? Is it Zimbabwe? Is it South Africa? And we had options. We're both very well qualified. Yeah. We can go to a new country, and there's a demand for our services. Both Tanya as a physio and me as a financial planner.
Yes. That's how you were observing, And
so we decided Botswana is where we want to be. We decided Botswana is the future.
Yeah.
Yeah. And then gradually over then the next few years, I slimmed down the firm, and we gradually folded the peripheral offices back into Botswana, made Botswana head office.
Yeah.
And then fast forward 5-6 years, then we look after clients in the region from here. Yeah. So yeah, by 2013, 2014, then we were back to, right, Botswana is the focus. All of our staff are here. We have trained up Botswana to fulfill all the roles of the guys in the region.
Yeah, absolutely. I mean, what I'm picking from you, James, is that you've always been an entrepreneur. You've always had that entrepreneur in you.
I've been a bit of a rebel, I think. Don't like being told what to do.
Is that what it is?
Maybe.
Because I wanted to find out, where did you get it? Were your parents entrepreneurs?
No. My parents are teachers.
Yeah.
My mother was a university lecturer. My father was a grammar school teacher.
Yeah.
My father taught technical drawing. My mother taught maths. They were very conservative people. They were cautious with their money. They taught me, my financial advisor was my mother. Still is, to a certain extent.
She was very frugal with her money.
Yeah, correct.
That's where you learned it from.
Yeah. They never got into debt. They saved. My father passed away about 10 years ago. My mother still lives in the UK. I don't have any brothers or sisters.
Oh, did you ask how are they using money?
Yeah.
Have they also learned the same, but you don't have any
so no siblings. Yeah. But my mother is now, she's going to be 80 next month. She has saved through her life. She has put money aside in pensions and in savings. And she leads a comfortable retirement.
Yeah. Does she live alone?
She lives alone. That's the only downside.
Yeah.
To having one son who then moves to Africa.
Yeah. Do you see her often?
I see her 4 times a week on Skype video.
Yeah.
So we have her for supper Monday, Wednesday, Friday, and then for breakfast on Sunday mid-morning.
Okay. Now, because just 2 weeks ago, I was actually posting about retirement planning. Now that you mentioned your mom, because she was actually planning frugally her finances, her pension funds, and now she's living a very comfortable life. My mom did the same thing. And this is something that we can learn from our parents. What advice do you think we should be giving people advice in terms of that kind of comfortable? You said savings. You mentioned savings, pension funds. One of the things I talked about as well was sometimes having one pension fund, it's not necessarily going to sustain the type of life that you had before, because it's actually the money that you're going to earn. It's not even close to how much you're earning as a salary now.
Sure.
What would you advise? I was saying you can have a couple of pension funds. There's no harm on that. Make investments and to have different streams of income. What is your advice on that in terms of having a sustainable and comfortable retirement?
Take it seriously from a young age.
Yeah.
Yeah. Like I can almost guarantee you that over 95% of your listeners will have maybe thought about retirement, but won't have ever sat down and figured out how much money they need every month coming in when they are 65 or 70. Yeah. Yeah. Less still have any idea about how they're going to generate it.
Yes.
Yeah. We use the word, pension. I'm contributing to a pension fund. We kind of give our money to a pension fund. We don't know where it's invested. We barely know how much is there. We don't know what rate we're going to get out of it in retirement. You might argue, well, people need to be better educated in retirement planning.
Yes.
But if they took it seriously, they would be. They would educate themselves. There's plenty of resources. You can come and talk to one of my financial planners here. First meeting, entirely free. And you'll just suck information out of them. Yeah, if you want to do that.
Make the effort. That's what you're saying.
Make the effort.
Yeah.
Take it seriously. People say, and they grin. Well, they say, I'll die before then.
Those kind of just laissez-faire kind of thinking. Yeah. So what do you advise we do?
Take it seriously.
Start off taking it seriously.
Go figure out. Okay. have a look. Don't take average life expectancy in Africa, which is maybe 50. Yeah. Realize that you're living in a first world country with first world standards of healthcare. Yeah. And that you as a professional have got access to information that people didn't have 50 years ago about how to live your life healthily. Yeah. How
to tip of your fingers,
exercise properly, diet properly. When you are sick, you go to a decent doctor. We take all of this for granted. That didn't happen 50 years ago. Yeah? So you can't take existing life expectancies. You've got to look at Europe, the US, Japan, places like that for life expectancy. And in those places, the average life expectancy at birth is roughly 80. Yeah. Now, if you've lived through all the diseases of childhood, and then you've lived through your risky 20s, and you've survived that far, then you get to sort of your 30th birthday, then your average life expectancy is over 80. Average. So for 100 people like you, 50 of them will live past 80. Yeah.
So we have a long way to go. This is what you're saying. We have a very long way to go. So the sooner we start planning for it, the better. I hear that. Now let's be on the nitty-gritty. Let's get to, the nitty-gritty of, somebody is sitting right now in their office, they're earning 50K. Or they have a contribution that they're making towards their pension fund, and that is all they have. Maybe they have a property that they're living in, maybe one flat or whatever. So, somebody doesn't have any investments, but they have this pension that they're contributing to. Or they don't have any pension that they're contributing to. Let's now advise that person right now. What is the best thing to do? I'm earning 50K, I'm earning 30K. How much should I be investing for me to have a comfortable retirement?
Okay. So, if you're earning 50K now the average person that's earning 50K, let's be blunt about this.
Yes.
Yeah? Are they taking home 50K?
No.
Where's it going?
Debt.
Right. Okay.
There's a car, there's a house.
You've already spent.
Yeah.
Yeah? You've already spent half of your salary. Yeah? You fool. You've taken out debt, you've made your future self poorer in order to gratify yourself with your Mercedes or your Land Rover or whatever, with the trappings of success.
Yes.
Yeah? And somebody said to you, use the bank's money.
Yes.
It's not the bank's money.
Yeah.
It's not the bank's money.
Yeah.
It's your money. It's your future self's money that the bank is facilitating bringing forward to today.
Yeah.
Yeah? And for that, they're charging you an interest rate.
Yeah, you are funding their lifestyle, basically.
Absolutely right.
Yeah.
So the average person who's earning 50K isn't taking home 50K. Obviously, we've got tax coming off the top. Perhaps they've got, if they're lucky, their employer's contributing some of the money to a pension fund. That's coming off. Then their debt payment's coming off, and they're actually living on 20.
On 20, maybe. Yes.
Well, that's okay. That 20 is what they're going to need in retirement, isn't it?
Yeah.
Because they're going to have to work until the debt's paid. When the debt's paid, they can afford to retire. Yeah. And at that point, they need the equivalent to 20K in
to maintain the same lifestyle.
The same lifestyle. But then they're also going to have extra medical expenses. There are going to be things that are more expensive. And perhaps there are going to be things that are less expensive.
Cheaper, because
you're
kids
not going to pay school fees.
Yes. Hopefully, yes.
You might have to pay...
University, maybe.
You might have to pay your kids' school fees. Is it your kids' university fees? Maybe. But you might have to pay your kids'
grandkids
school fees.
Yeah. That happens. That's very, very real.
Yeah. So here's the saying. The best thing you can do for your grandchildren is to be financially independent in retirement. The best thing you can do for your grandchildren...
Not for your children.
Why? The best thing you can do for your grandchildren is to be financially independent in retirement. Because so many people retire and then want to be dependent on their children. There's a word for it. What do we call it? We call it black tax.
Black tax, yeah.
Right. Yeah. So they suck money out of their children, which means their children can't invest in their grandchildren's education, which means that we stay in poverty.
Yes.
If you're financially independent in retirement, you can support your children and you can support your grandchildren. And then for your grandchildren are going to get a far better standard of education than you ever got.
Yeah.
Yeah, and that's a virtuous circle.
Yeah, that's basic virtual. But, you know, the thing is, James, I'm trying for us to avoid that. You get what I mean? This is what I'm trying to do. I'm trying for us to educate the one that is taking 20K right now and is earning 50. How can we make sure that they clear that debt faster so that they are not in the cycle?
Debt is an addiction. Debt is an addiction like drugs are an addiction. Debt is an addiction like alcohol is addictive. Debt is an addiction like gambling is an addiction. Yeah? And the greatest trick the devil ever pulled was to teach the world that he didn't exist. And I firmly believe that debt is the devil. Itself.
Right. With the two horns, yeah.
Correct. People say to me, well, there must be something, James, there must be some sort of thing as good debt. Yeah?
Is there something that's good debt?
Yes, there's one thing, there's one thing and one thing only that is good debt. Okay? That is the money you borrow to put a roof over your family's head.
Yeah.
Yeah? So if you go and take a mortgage to buy your family home, and therefore the repayments on that mortgage replace your rental that you'd be paying anyway.
Yeah.
Yeah. And you know, so that's the interest. And then you repay a little bit of the capital. Yeah. Then, and you've got a life insurance payment there, credit life, that if you drop dead, the debt's paid. Yeah, then your spouse and your children have an asset.
Yes.
Moreover, you're going to take care of that asset. When you own that house, if a crack appears in the wall, you're right.
Yeah. What about debt? Getting debt to make investments, for instance, getting debt to build multi-residential for rental. Do you already own the house? Yes, you've already owned the house. That's paid off, or whichever, or you can get two of them. You know, pay both of them at the same time. But you know, ensuring that if he stays money,
all right. So you're now going to use debt for investment. What does debt do to an investment? It makes it more risky. So maybe that risk will pay off for you. Maybe it won't. Yeah. But that is debt to run a business. Yes. People talk about property as passive investment. It is in no way, shape or form passive. Yeah. Property, you need to be on it every day.
And maintain it. And yeah, it's actually very high.
Find a new tenant, collect the rent, do your tax returns, pay your accountant, as well as maintain the property.
Which is the highest cost.
Right.
Yeah.
Yeah. So I've worked with some very successful property investors who say that the cutoff is 8%. 8% gross rental yield.
Yeah.
Okay. If you can get 8% gross rental yield, then you can afford a couple of void periods. You can afford a couple of tenants wrecking the place. You can pay some taxes. You can maintain the property.
Yeah.
And maybe you can keep half of that.
Yes. So what is your advice on that? I'm still not getting the answer on is it a good investment for you to get debt and buy property?
How would I possibly know without knowing the property, without knowing the business, without knowing the individual? You can't give broad sweeping statements about is hypothetically this a good investment. It can be for some people. But it can go disastrously wrong for other people.
Okay, let's be in the instance that it's good property. This person, let's give a good scenario.
So number one, it needs to earn more than 8% gross rental yield. Yeah. Number two, you need to borrow less than 50% of the value
of the property
of the asset value. That's just the way. I mean, I can work through the figures with you.
Okay.
But I don't think it's that kind of podcast.
Okay, no, I just wanted us to have it.
I'm just giving you some rules.
Yeah.
So 25 years of doing this, I have taken really, really deep dives into what works for people and what doesn't work for people. The problem that most people have is the financial advice that they get is from friends and family. And with friends and family, you only hear about success.
You don't hear about the struggle.
Right. You definitely don't hear about the things that go wrong.
Yeah. And it's quite interesting. I always say that, I don't think we're a nation that shares a lot, particularly on the struggles. We always want to share the success on the struggles, on the real struggle of, so that we give a clear and real picture of it. So, but what, James, like I said, you are here to give the solutions, the realistic solutions, the practical solutions, because the viewer right now doesn't want to hear the technical. They want to hear, okay, is this a good idea or not? And what you're saying is it depends on a lot of factors, but a good scenario is that it gives you 8% debt and at least 50%, So I want us to give solutions.
So here's the issue with property, is that most people, when they get some success, what they like about it is the trappings of success. They like the show-off bits.
What people think.
They like the bling. Right.
It's always what the other person, the perception of what it looks like from outside.
So what do they go and buy as a property? What property is most attractive to them?
It's some big nice house that looks...
A big fancy house. Or an apartment at the top of High Towers. Because it looks fantastic. Those properties yield the lowest. So you find that these people are investing in properties that are earning them 3 or 4% gross rental yield, not 8%. Yeah? If you want a high gross rental yield, go buy a house in Old Lady. The multi-reses in Old Lady earn far more than anything in Pakalani.
Why? Because it's low maintenance?
Because it's unattractive. You're not paying that fancy premium. You can't go down the pub and say, hey guys, I just bought a property.
This is for rental, of course,
This is for rental.
Yes, yeah. So now, what do you think about the 2-3 bedroom houses? No, small, apartments, which I noticed are also quite a hit recently. I mean, look at the Sarona in Solofelo.
Yes.
And all that. They look like, because of, I always say this to my clients, because you always have to look at the demand and your market and how, because we are quite a middle class country. And therefore that means the 2-3 bedroom, 1 or 2 bedroom work. Literally today you have a tenant, they leave, tomorrow you have a tenant.
Right.
Literally. And they actually are always fully and low maintenance because they're small. You don't want anything too costly to maintain. Do you think that's a good one as well?
Yeah. Just stick to the 8% rule. Yeah. If that property, everything in, if it's going to cost you $1 million pula, 8% of $1 million is 80,000 pula. You need to generate a gross rent before any expenses of 80,000 pula a year. If you can't get that, walk away from the property.
Or walk away from that debt.
From that deal. Don't forget about using debt to do it or anything like that. Just like, if you can't get 8% gross rental yield, don't buy the property.
So it's not worth it. All right.
So what happens with property is you have a return from rental income and you have a return from the capital appreciation of the property.
Yes.
Now, generally, over the full market cycle, the value of the property will keep pace with inflation. That's all it'll do. So the value of the property takes care of your inflation issue. Yeah. Your return is all rent. Now, the property guys will tell you, hey, it'll double in value, blah, 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 blah. Yeah. Sure. At 7% inflation, things will double in value in 10 years' time. Yeah. At 10% inflation, things will double in value in 7 years' time.
Yeah.
But generally, over the full market cycle, a property the value will keep pace with inflation. Your return is your rent.
Your rent. Because
so that rent has to be high.
No, absolutely. I mean, right now, not necessarily high. I don't think it is necessarily.
As a percentage of the value of the property,
yes,
it does.
Yes.
Otherwise, don't go there.
Don't go there. Because I think, to be honest, also right now, if you're looking at the property market right now, it's doing really badly in terms of the selling of the property. You know, property is not getting easily sold right now because of the economy. Of course, I know people don't have the buying power. Debt is expensive, and also it's not easy access to debt anymore. So that's another thing. This is basically the point that you're making, that you better be dependent on the rental more than the selling, because sometimes you will sell it at very less value. Actually, you will actually make a loss depending on how the market is doing. So let's talk about now.
Most of the offices in iTowers are occupied by the people who built iTowers.
Yeah, the offices.
And the residential as well,
And
to be perfectly honest. But you go take a look. Who actually owns those offices? They tend to be the people that finance the development in the first place.
Yeah.
Because it doesn't really make good investment sense. It's a trophy.
For this market. Is it for this market?
For any market.
Let's say maybe we're in New York, or we are in, does it not depend where you are? Like, for instance, the money power, the accessibility of the millionaires that can buy those cash and be able to actually have people that will rent the penthouses at that particular $50,000 a month.
I know the London property market.
Yeah.
So the London property market is full of overseas investors. A lot of Chinese investors who are very worried about China, and they take their money and they stash it in the UK.
Yeah.
But they don't want to put it in the bank because bank deposits don't keep pace with inflation. So they want to buy a property. But they don't want the hassle of the tenant. Rental yields in London are 2.5%, 3%.
That's low.
Terrible.
Yeah.
So what they do is they buy a property and they don't put any tenant in it. They just go, okay, I'll forgo the entire yield. All I want is something that keeps pace with inflation. So there are millions of apartments in London that are basically untenanted.
So what is your point here?
So my point here is realize what you're trying to do, get out of your investment. Yeah? Would I do that? Hell no. Yeah. The next thing about property is it's got to be close to you. It's an active investment.
To see how to maintain it. Is it when you say close, you mean
physically close?
Physically close, yeah.
Yeah. When the tenant phones you up and goes, the aircon's broken,
you need to be there.
Well, you can obviously employ somebody to go and do this.
It's not the same.
But there's a cost. Yeah.
So then it loses the value of your investment, the cost that is involved. So if you actually own a property in Joburg, are you really, really earning anything from it when you have a whole property estate agent maintaining it? You're paying them. You're doing. Is it really what this is? What you're saying?
You pay the estate agent 10% of your rent to manage it. Yeah. Then you don't know the South African tax system. So you're going to have to go and employ an accountant down there to get you through the complexities of earning income in South Africa. You don't know anything about transfer duty there. All of these things. But most of all, it's a schlep to go down there to maintain it, to look after it, to go and have a look at it.
So you need to hire someone to do it. So it becomes more expensive. The return goes lower. This is basically what you're saying. Yeah.
So if you're going to invest in physical property, buy something close to you. Yeah.
So the advice that you just gave right now, James, is, obviously we're talking about the investments that we can make for us to, diversify our income post-retirement, so that we have that income. So what you were actually basically what we're breaking down now was, if you invest in property, this is what to look out for it to be an actual investment for you.
Yeah.
This is basically what you're saying. What else can we do? You are into offshore investments, and this is what SCI does.
Yeah,
let's talk about that one.
Let's just mention the word offshore first of all.
Yes.
So my firm advises on investments here in Botswana and internationally.
International, yeah.
The idea of offshore is kind of a South Africanism for international investments.
Offshore, you don't like the word offshore?
Well, so the technicality of the word offshore is basing your money in a jurisdiction that doesn't tax you if you are off its shores.
Okay. So we shouldn't call it offshore investment, is what you're saying?
Well, it is easier to understand if you call it international.
International investments, okay.
So international investments. So if we're investing money, we're not investing money offshore. We're investing it in companies that are very much onshore. Yeah. So you've got an Apple laptop sitting in front of you.
Yes.
Yeah. So the largest company in the MSCI World Index is Apple.
Yeah.
It's not an offshore company. It's an international company. It sells its products all over the world. Yeah. My laptop's a HP.
Yeah.
It runs Microsoft Windows, Microsoft Office. It has an Intel processor. All of these are companies that are technically domiciled in the US, listed in the US, but sell worldwide.
Yeah, so they're right here with us. This
Right.
is basically what you're saying.
Yeah.
So let's talk about investment besides property.
Okay. So
diversifying your income.
5 asset classes: cash, bonds, property, equities, and commodities. Those are the basic types of investment. Okay. So cash, you give your money to the bank. The bank says to you, you can have that back tomorrow, no problem at all. And then they lend it to somebody else for a 25-year mortgage. So like cash in the bank, you think there's cash in the bank? There's no cash in the bank. Yeah. Banks run on a margin of about 10%.
Yeah.
So the money that's there in the bank is about 10% of their deposits.
Yes.
If more than 10% of the people want their money out of the bank's bust.
Yes. This is why they want you to remain investing, leave your money in your savings, as well as they need the debt.
Right.
Yeah.
So, so cash, good for the short term, good for, not a great investment. Cash doesn't keep pace with inflation.
Yeah.
The inflation is what erodes the buying power of your money. Okay. Bonds. Now, bonds is where you lend money to generally an entity.
Yeah, yeah.
It might be a government.
Yes.
Government bonds. Buy that bond, you're lending money to that.
Yes.
The return on that is a coupon. It's called a fixed income.
Yeah.
Yeah. So there will be let's say you lend the American government $100.
Yes. No, let's do it here. Let's bring it here. We're lending the Botswana government
Then in the Botswana government, I don't know what and down the edge of it, you would have tear-off coupons. And each one of these would have a date on it and an amount on it.
Yeah.
Yeah. So let's say that the rate is 4%.
Yeah.
Yeah. So each coupon would be 20 pula every 6 months. And you tear off the coupon and you go and redeem the coupon on your bond.
Yes.
Okay. So not fixed as a percentage, fixed as an amount of money.
Yeah.
Okay. So that's a bond. Now, I own this bond, but it doesn't say my name on it. So then if before 10 years are up, I can say to you, would you like to buy this bond off me? And you collect the remaining coupon and you collect the face value. So it's a tradable instrument.
Okay.
Okay. So typically traded on the stock exchange.
Yeah.
Okay. So that's a bond.
Yeah.
Bonds pay interest. The price that you might pay me for that piece of paper can go up and down.
Yeah.
Okay. So true investments, their value fluctuates over time. And if you want to avoid risk, you choose an investment where you know what the value is as it goes up and down. Because what you want to do with an investment is buy low and sell high.
Yeah.
Now, most people make a mistake. They buy things that have done well in the past, so they tend to buy things high. And then if they do badly, then they sell them.
So the idea is to just leave your money invested for a longer period of time so that eventually it goes, because it does go, like you're saying, it fluctuates and eventually it will go high again.
Okay, so the way to mitigate the short-term fluctuations is by leaving it there for a long period of time. So in the short term, it can fluctuate. In the long term, it can grow.
Yes.
Markets in the short term are a voting machine.
Yeah.
People say, well, this company is in favor or out of favor, or this bond is in favor or out of favor.
Yeah.
So in the short term, they're a voting machine. In the long term, they're a weighing machine. Yeah. So the closer that bond comes to maturity, the more certain its value is, because it's going to pay back that 1,000 pula. Okay.
Yeah.
So we've talked about cash, we've talked about bonds, we've talked about property.
How do you buy bonds?
I don't buy direct bonds. Buying bonds is complex, generally for institutional investors. So I would use a bond fund manager.
Yeah.
Okay.
This is an
Use a
asset manager.
professional.
Yes,
Use
an asset manager, yeah.
Bingo.
Yeah, basically, asset management companies will help in the buying of bonds.
Right.
Yes, all right. Okay.
So for Botswana watching your podcast, listening to your podcast, the easiest way to get into this is with a money market fund. Okay, so there are, I think, 3 technically money market funds and a couple of enhanced cash funds in Botswana that invest in low risk deposits, cash deposits, and a couple of bonds as well.
Yeah, okay. And not necessarily Botswana, even any international that is.
Oh, sure, any absolutely.
Yeah. All right, okay.
But come and talk to a professional about it.
Yeah.
And then make sure that professional is working for you and not working for a bank. It's important that they're on your side.
Yeah. They're not selling for somebody else. This is basically what you're saying.
Yes.
They also want to benefit as much as you benefit. Is that it?
They want you to benefit.
More than anything.
Yeah. They want, my goal for our clients here at SCI is that they are financially more successful.
Yeah.
I have a very long-term view of growing my company. And that's been successful over the last 25 years. But to do that, you have to say, well, I want the client to be successful.
Yeah.
You can't be coming along to people saying, well, I need to sell this product.
Yeah. Got you.
Okay.
All right, let's go to the next one.
4th asset class is equities.
Yes,
so equities is a share in a company. Now, an entrepreneur might own 100% of their company. Yeah. But that company, typically with entrepreneurs, is dependent on them. So if they fall sick, that company's in trouble. Yeah. Especially in the early stages. When you get big and you maybe get 20 employees, it can run itself.
Yes.
So because there's risk, high risk involved in your own company, you wouldn't do it if you didn't expect high returns.
Yes.
Okay, so generally, risk and return are linked.
So the higher the risk, the higher the return, normally?
No. The higher the return you're chasing, the higher the risk you need to take. Okay, so you can't expect a high return just because you take risk. Yeah, you can't jump off a cliff with a parachute
and say,
and go, this entitles me to some return.
I see.
Yeah. So you need to find a way of mitigating that risk. You need to understand that risk, but you can't target a high return. There's no such thing as free money. Anybody who comes to you saying that I can get you 20% return a year is either a scamster or they're hiding the risk away somewhere.
Okay. It's too good to be true. This is what you're saying. Yeah.
No such thing as free money. In the investment world, what we're trading for some free money. The return on investment is free money. Yeah. But what we're giving the ability to take that risk.
Yeah.
Okay. And that risk in the investments that I talk to my clients about is valued every day and so goes up and down.
You're managing it even. Yeah.
You can see it.
Yeah. And do you give your clients reports on monthly reports on what's happening with your? So tell me, what
clients log in and they can see what their portfolio is valued at today
and what it means. Because sometimes they know, but not necessarily understand.
And then they can come and sit down with one of our advisors.
Yeah.
We've got half a dozen guys in the firm who are qualified financial planners.
What makes a good asset manager?
Somebody with their eye on cost. So a lot of asset managers are in the asset management business just to earn high fees. And in order to justify high fees, they therefore take higher risks. And then they try and downplay these risks to their client. Okay. So what you're looking for is efficiency in a fund manager. Yeah. And then second to that, transparency. Yeah. The firms that I will use to invest my client money. We as a company, we don't touch our clients' money at all.
Yeah.
We don't handle money.
Yeah.
So if we're going to select an asset manager for our client, that asset manager has got to be able to give these valuations transparently.
Yeah.
They can't be saying, oh, well, I'll get back to you in 2 weeks' time. And we do see that from some asset managers, and then we don't use them.
We don't use them, yeah. So what you're saying is you're very big on customer service. and,
Sure.
and the relationship management and making sure that the client is protected.
I am very clear about the value that we add.
Yeah.
We add understanding our client and helping our client get good outcomes.
All right. So you were talking about equity, buying of shares in a business. How does one do that?
So typically, again,
The steps.
buying an individual company, buying shares in an individual company, even if it's a massive company, is risky. How do you know that the price that you're buying, let's say you want to buy an Apple share,
Yeah.
how do you know that the market tomorrow isn't going to value that less? Obviously, you hope that Apple is going to grow over the next 10 years and that share is going to be worth more.
Yeah.
But you don't know that for sure. Apple could turn into BlackBerry. Apple could turn into Nokia. Apple could turn into Yahoo. Just because it has been successful doesn't necessarily mean it's going to continue to.
So how do you measure
So you
that?
diversify.
Diversify your investments. Yeah.
Right. So locally here, if you want to invest on the Botswana Stock Exchange, I would highly recommend that you use an asset manager to do that investment for you, because they can buy lots of different shares.
Like the unit trust, is that it?
Correct. So the way that a normal investor would do it is go and buy a unit trust. Okay. Try not to pay high upfront fees. There are unit trusts out there with 5% upfront fees. Negotiate that down.
Yeah, that's high.
That's high.
Yeah, okay.
All right. So that
What is the best rate?
you can get in at zero if you know what you're talking about.
Yeah.
You might have to pay a fee to somebody to help you set it up.
Yeah, but that should be it.
That's it. Okay. So come chat to the advisors here and they'll point you in the right direction.
Yeah.
But then that asset manager will buy not just BTC shares, not just BBS shares. It'll buy all of the many different companies in the market. Internationally, the easiest way forward is to strip out a fund manager altogether. So you can just buy the index of all of the companies. So the MSCI World Index, MS, Morgan Stanley.
Yeah, so we're removing the middleman, is what you're saying?
Remove that cost of somebody having to pick individual stocks.
Yes, internationally.
So there isn't a good index ETF here locally. There's not liquidity on the BSEs. You can't do it here yet.
Yes, no, I hear you. But what you're saying is here, use an asset management
company. Here you have to use an asset manager.
Yes, and then internationally, best not, because that fees are too high. Is that it?
No, I won't say. So we do use some asset managers internationally. But if all they're going to do is track the index.
What is the index?
I'll just buy the index. Okay. So the index is the value of, in terms of MSCI World, 1,650 companies.
Yeah.
That is the value that you would have if you bought shares in every single one of those. Yeah. And you do that, you buy the index, and then you have exposure not just to Apple, not just to Microsoft, not just to Shell or BP.
But all of them.
All of them.
So that's like the unit trusts internationally.
Yeah, but a unit trust will typically only be able to buy you internationally 60 or 70 shares, whereas an index, 1,650.
I see.
Right.
That's the difference.
Big difference.
Yeah.
Okay.
All right.
In terms of investing in specific areas, then we'd use a fund manager. So if so there isn't a good index that covers frontier markets, things like South Africa, Mexico, Indonesia, Vietnam.
Yeah.
So we'd want a fund manager to go there and select the companies to invest in.
Yeah.
But generally, index investing, passive investing is the way forward, in my estimation.
In your opinion, yeah. Let's talk about compound interest investments. I actually spoke about it on the part of investing, diversifying your income for retirement. I want you to explain it.
Okay.
Yeah, I explained it, but I want you to. What is compound interest?
So simply, you leave your money invested so that you are earning interest on the previous year's interest as well.
Yeah.
Yeah. So let's take an example of 10 years earning 7% per year.
Yes.
Okay. If you just take that 7% out each time, you're going to go 7, 7, 7, 7, 7, 7, 7, 7, 7.
Yeah.
You're going to
Each
get
year.
70%.
Yes.
Yeah. But if you leave that first 7 there invested, and the second year you put in 100 poo, let's say. Year 1, end of year 1, you get 107. Now the 7% in year 2 is 7% of a larger amount of the 107. And what that results to over then that 10-year period, 7, 7, 7, compounded, doubles your money, gets you a 100% return, not a 70% return. So by rolling over your money and reinvesting your money, you've got a better return.
Yeah.
So that's compound interest, and that's the cornerstone of investment.
Yes. So if one wants to make compound interest-bearing investments, how do they do that? Is it the same way as buying equity?
Well, okay. So if you buy Apple shares, Apple will pay a dividend.
Yes.
Yeah. So yes, the Apple will be reinvesting in its own company and compounding up that return. But really, what you want to do is reinvest the dividends as well.
Yes, that's exactly what I'm trying to get to. Yeah. Instead of actually cashing it, keep reinvesting over time, it remains invested, and you just keep getting.
When you just Google Botswana money market funds, if you're not into investments, if this is your starting point, Google Botswana money market funds, and you will come across some pages of asset managers that run a money market fund in Botswana. And you will see on their fact sheet the effects of compounding. If they started 20 years ago, and if you'd just taken that interest and reinvested it all the time, and the curve goes up like that. Yeah. Whereas if you hadn't, the curve would just be much flatter. Yeah. So compound investing, important for the long term.
Yes.
And let's face it, earning 10% on your money, whether it's 10 or whether it's 7 or whether it's 12, doesn't make a big difference in 1 year.
Yeah. So it has to be over the long term. So investing, basically, I think the message I'm trying to communicate here is investing is long term. It is best long term.
Yeah, well, yes. But you still need to earn interest in the short term. It's pointless letting money go to waste. But you can't take risks if things are important in the short term.
Yeah.
Remember, investments can go down as well as up.
Yes.
So if you know that you need to educate your kid and you need to pay school fees this time next year,
then it's best to just cash it. Yeah, I get you.
Leave it in low risk cash deposits, a money market fund. Don't invest it in an equity fund. Because the equity fund, on average, will go up more. But in the short term, it's got risks. It can go down as well as up. Yeah,
because the money market has very low interests.
It's yielding about 7% in Botswana at the moment. Better than any bank. So the money market funds work really, really well for people in the short term.
Short term.
And
so long term? Long term is the equities,
Yeah, it's going to keep pace with inflation there or thereabouts.
But that's where you're there for.
Absolutely.
That's what I'm trying to communicate is because there is, and in our country we're a very impatient nation, if you know that. We're not very. You've
said this a couple of times, and I want to pull you up on it.
The reason why I say this is
this is not a problem for Botswana. It's a problem for the whole world. Yeah. We as people we consume too much social media, we consume too much TV, and it makes us want things easily.
Today.
Yeah, and we don't see the struggle. We don't see other people struggle to get where they get to. They think we see the YouTuber or we see the TV star.
Instagram,
Instagram people. And we see the instant success, and we think, hey, I want that.
And is it even there? Is it even success?
Perhaps not.
Perhaps not. Perhaps it is, but you haven't seen how they built it
how
together.
They got it.
Yeah, I think that's the point you're trying to make. But the point I'm trying to communicate is, the first you've already communicated that let's try and avoid it. Let's try and pay it quicker. But now let's talk about the importance of long-term investing and being patient because if we promote the money market too much, that's where they're going to go. So it's very, very important.
Yeah, but it's a gateway. It's a gateway.
Yeah.
You start off with money market, and so your target should be between 3 and 6 months money.
Yeah. That's emergency funds, for instance.
Correct. Yeah. So let's go back to your hypothetical client earning 50,000 pula a month. Yeah. First of all, stop making your future self poorer.
Yeah. By debt, by incurring too much debt. Yeah.
Yeah. All you're doing by incurring debt is borrowing from you in the future. Yeah. Stop it. Like, that's not how you get wealthy. Yeah. You want to make your future self wealthier, not poorer.
Yeah.
So stop the debt thing. That's priority number one. Priority then, the second thing that you want to focus on is emergency fund. So why? Because then you can borrow from yourself when the shit hits the fan, and your aunt phones you up and says, like, I need a contribution for the funeral or whatever.
You're able to just take from yourself.
You borrow from yourself.
Yeah.
You borrow from yourself and then you put it back. Yeah. And money market fund, you've got 2-day liquidity. Yeah. It's earning interest every day. It's great. You can get hold of it, but you can't get hold of it to just go shopping. Yeah.
It has to be for strictly emergencies.
So you've got some discipline.
Or for school fees, like you're saying.
Oh, so absolutely for school fees. Yeah. But so the emergency fund is the second thing, and the money market is the gateway to that.
Yeah.
Your goal for your money market. Let's say this person is spending 20,000 pula a month.
Yeah.
Yeah. You need between 3 months and 6 months money.
Yeah.
So 3 months money at that, 60,000 pula. That to that person might sound like a lot of money. Yeah. So they need to pay down some debt and start saving.
Yeah. What is the ratio between, do you think, if you're, I want us to we're just about to wrap it up, because you do have a meeting in 5 minutes. So just wrap it up. I'm heavily indebted, but I also want to save. Okay. Priority. Yeah. How do I balance my money? Do I take all of it to debt, or do I take at least a bit of it to emergency funds?
If you are heavily indebted, it's stressing you.
Yeah.
It's impacting on your everyday life. Now, your most stressful debt might not be your most expensive debt.
Yeah.
Your most stressful debt might be the debt to your sister.
Yeah.
Yeah. That means that when you go to a family gathering, you feel awkward.
Yeah. Yeah. The relationships are affected, basically. Yeah.
Bingo. So focus on that.
Yeah.
Yeah. So that you can heal yourself.
And fix the relationship. Good, what you're saying doesn't even have to necessarily be the big debt. It could also be that one.
It might be that one.
Yeah.
Okay. So the way that I recommend, the first thing you have to do if you're in debt is you have to, and I cannot emphasize this strongly enough, you have to write them all down.
So that you don't miss any.
So that you confront them.
Face them.
Yes. Because I've never been to an Alcoholics Anonymous meeting, but I hear about Alcoholics Anonymous. Yeah. And do you know anything about AA for helping people get away from alcohol debt?
Yes,
alcohol.
Debt. Alcoholism. Yes, I get you. The addiction.
Alcohol addiction. Yeah. So one of the first things they say is they stand up in the meeting and they say, "Hello, my name is
James,
and I am an alcoholic."
Yes.
The first thing you do is you confront your addiction. Yeah.
Face it. Yeah.
You face it. So with your debt, you have to write it down because it forces you to confront your addiction. Confront it. Okay. Phew, that's the first step. A lot of people never make it that far because they're ashamed of this or that. Yeah. So you write it down. Then you figure out what's the most stressful.
Yeah.
Yeah. Now, in addition to this, might be I need to save for my school fees as well.
Yes, that's my point. Yeah, that's actually the question. Yeah.
So if the bit where you have to come and pick up your kid from school because the head teachers made them stand outside the gate because you haven't paid the fees on time, if that is more stressful than the debt that you owe to,
prioritize that. Yeah. So you prioritize the more stressful one.
Yeah.
That's your view. Yeah.
Yeah. Because we can't operate when we're beating ourselves up all the time. Yeah. We have to clear the decks, confront the way that life actually is, and prioritize.
Yeah.
Okay, great. Now I can see them all. It's not actually as bad as I thought. I can take that one, focus on that, make minimum payments on the other. Now this is called
always snowballing.
Snowball method.
Yeah.
Right. You and I both love the snowball method.
Yes. No, I love the snowball because it doesn't matter the interest. Just pay.
Pay the one that's most stressful first.
Yeah.
Now the accountants, the ones and the zeros guys, will say pay the most expensive first.
Of course.
But the human in us, pay the most stressful first. Pay the one that we're most ashamed of first.
Yeah.
Get rid of that. Once you've paid that, then you can double up on the next payment.
Exactly. Because sometimes the ones with the higher interest, you find out they are more understanding. They can even wait, or they can even take the little that you have as compared to the one that is less understanding. Yeah. Or just focus on the little ones first. Maybe the higher debt, they're also more understanding. Because you find out more of the higher debt is the banks, is the who are normally more understanding when you actually say to them, they're actually not as horrible. But James, we've come to the end of our
that was
interview.
Quick.
Yes, because you have to go. We have to manage it well and not take most of your time. But thank you so much for the lessons today. I'm hoping they have helped the viewer as much as I'm sure the whole team was learning here today.
Last thing.
It's
not about ideas. It's about implementation.
Yeah.
Okay. So if your viewer, your listener is out there hearing this, do something.
Get up and just do it.
Sohan.
Do it.
Do the first step.
Yeah. And the first step is debt, list them down.
Do it now.
Yeah. List them down, contact your debtors, tell them what your plan is, and prioritize money towards that. Go and open the money market. Go and start saving.
Pick up the phone to SCI. Pick up the phone to Lorata.
Yeah.
And say, hey, I like what you were saying. How can we move forward from here? Do it. Sitting there in your car thinking about it isn't going to help.
Yeah. Or sitting there watching us converse only. The reason why we're doing this is for you to act on it. That's it. Yeah. Thank you very much.
You're most welcome.
I had hoped that we touch on your personal finance management, but it's fine. We'll do that next time.
We'll do it another time.
We'll do it another time so that we can talk about what your retirement plan is.
Yeah.
Yeah. Who's going to take care of you as well, so that we give practical, practical advice. But thank you so much for coming today.
You're most welcome.
We really appreciate the lessons today, guys. I hope you've enjoyed this as much as we did. Bye for now.